What's going on, everybody? This is Coach Wade. Today, I want to talk about one of the biggest debates in the investing world: index funds versus actively managed funds. If you ever started researching investments, you've probably heard people arguing about which one is better. Some people swear by index funds. Others believe actively managed funds are worth paying more for. So, who's right? Well, the answer isn't as simple as picking one side. Let's start by understanding what each one actually is. An index fund is designed to follow a specific market index. It doesn't try to beat the market. It simply tries to match the performance of the index it's tracking. For example, an S&P 500 index fund is designed to follow the performance of the S&P 500. A total stock market index fund is designed to follow the overall U.S. stock market. The goal is simple: own the market instead of trying to outsmart it. Now let's talk about an actively managed fund. An actively managed fund has professional investment managers making decisions about what to buy, what to sell, and when to make those changes. The goal is usually to outperform a particular market index. In other words, they're trying to do better than the average. Now that sounds pretty good, doesn't it? After all, if someone could consistently beat the market, who wouldn't want that? But here's where things get interesting. Trying to outperform the market is much harder than it sounds. Markets includes millions of investors, professional analysts, institutional investors, and an incredible amount of information that changes every single day. Consistently staying ahead of all of that over long periods of time is a difficult challenge. That's why some actively managed funds outperform the market during certain periods, while others don't. And sometimes a fund that performs well one decade may not perform as well the next. Now, here's another difference: cost. Remember our lesson about expense ratios? Actively managed funds often have higher expenses because there's a team of professionals researching companies, making investment decisions, and buying and selling securities. That work costs money. Index funds, on the other hand, simply follow an index. Because they're generally less expensive to operate, many index funds have relatively low expense ratios. Now, let me ask you a question. Can anyone consistently predict which actively managed fund will outperform over the next 20 or 30 years? That's a very difficult question to answer. Nobody knows the future. That's why many long-term investors appreciate the simplicity of index fund investing. Instead of trying to predict which fund manager will perform the best, they choose to own a broad section of the market and stay invested. Now, here's something important. This conversation isn't about saying one approach is good and the other is bad. There are talented investment professionals managing actively managed funds. Some have produced strong results during certain time periods. But it's also important to understand that higher fees don't guarantee higher returns, and past performance doesn't guarantee future results. As an investor, you should understand exactly what you're buying. Now, here's something I love about index funds: they remove a lot of emotion from investing. You're not constantly wondering, should the manager sell this company? Should they buy another company? Instead, you're simply participating in the performance of the market you're tracking. That simplicity makes it easier for many people to stay focused on the long term. As I teach in stage 4 of the 7 stages of financial independence, the wealth building zone, investing isn't about trying to hit a home run every year. It's about building wealth consistently over time. I encourage people to work toward investing 15% of the household income for retirement, not because one investment guarantees success, but because consistency, diversification, and time have historically been powerful ingredients in long-term wealth building. Let's talk about something that often gets overlooked: behavior. You know, I've learned that most people don't fail at investing because they choose the wrong fund. They fail because they panic. They stop investing during market downturns. They chase whatever investment is popular this year. They jump from one strategy to another. Successful investing is often less about intelligence and more about discipline. The best investment plan in the world won't help if you abandon it every time the market gets scary. Here's what I want you to remember: index funds are designed to follow the market. Actively managed funds are designed to try to outperform the market. Both can play a role depending on the investor's goals, preferences, and overall investment strategy. The key is understanding the difference, knowing the costs, and choosing an approach that fits your long-term financial plan. I'm Coach Wade, and I believe investing doesn't have to be about finding the smartest person in the room. It doesn't have to be about predicting the future, and it doesn't have to be about chasing yesterday's top-performing fund. It should be about understanding what you own, keeping your costs reasonable, staying diversified, investing consistently, and giving your money the greatest advantage it has: time. Because wealth isn't usually built by making one perfect investment decision. It's built by making good decisions over and over again for decades. I'll see you in the next lesson.